Hello, everybody. Welcome to Friday. Another session of Go Live with Tom today. Really looking forward to today's show. Actually, we already have several really good questions, and we've done some preparation on those. But the format on this is just basically a Q&A session. You can send in your questions. The email address is right here on the bottom of the screen. It says Ask Tom at golivewithtom.com. Just send that in as an email, and then Eason, who's joining me today, it will be the moderator, and he'll ask some follow-up questions. You can ask him questions directly if you'd like, and we're just going to have some fun with this. And again, we believe here at Retirement Capital Strategies, there's basically four pieces of building wealth. One is financial planning, another is tax planning, the third one is investment management, and the fourth one is investor knowledge. And so we work really hard on all of those. And this show is about investor knowledge. We put out a daily video, and then we're putting out some special videos that we're working on right now. So, for example, we're going to do a piece on cybersecurity ETFs because that's a really hot area right now. And if you want to get those videos, they're going to be placed on our channel. And if you want to know about them, you want to subscribe to the channel, there's a subscribe button right there that you can see on the channel. You can hit that. And then if you want to get notified every time we put something on the channel, you can hit the little bell that's there also, and that'll send you an email as far as that goes. So, really looking forward to today. I want to thank you very much for joining us. And why don't we go ahead and get started with the first question, Eason?
So, as you saw today, it's been a bit of a rough red day today, and the market's falling.
Yeah.
What do you recommend we do or someone do in this kind of market?
Okay. So, first of all, two things that happen. Number one is every time there's a downturn, uh, there is more information given, in my opinion, by the market than when we have upturns. Because one of the things that I watch for very, very closely is what falls less. And you can really see what people are interested in. Sometimes in upturns, you can look at it and say, oh, these things are going up faster and that's exciting, but they don't have as much staying power as things that I generally find that are holding up better in down markets. So I actually kind of take these times and I put way more focus into all of the different options that are out there during downturns, because I really feel like that's a time that you can learn something. And we have, if you check on our channel there, we have kind of a 4-step process for dealing with downturns. And so the first step is really all you'd want to deal with right now, because this market isn't down that much. And that is to figure out, what's holding up. I like to say to myself constantly when I'm going through charts or looking at investments is, where is the money going? Where is the money going? And so let me share my screen and I can kind of show you, an example of what I would look at as far as that goes. Okay, this is a program called Y Charts. It's a really great program, actually. And what I'm showing here is just the last week. And so, obviously, as Eason said, it's been a rough week. This is VTI. Okay, so VTI is the Vanguard Total Stock Market Index. This is my base. I use this constantly. And what this is the essentially the entire U.S. stock market. It incorporates almost every stock except for some of the very, very, very small stocks. And so I use this as a benchmark constantly. I want to see how things are going because to me, everything's relative, and relative in this case to VTI. And so you can see here on this chart over the last week, we're down 1.86% as of right now, last few minutes here. And so, what's happening out there? And so I go through a series, and I'm going to give you a very simplified version of what I normally do here. I go through hundreds of these different exchange traded funds to kind of see what's going to happen. But one of the things I always like to do, and I'll click this here and we can see kind of a side-by-side comparison. So now we're looking at VTI, which is the purple, and VXUS. Okay, so this is a Vanguard index that is the total international stock index. So again, this is a vast majority of the stocks that are out there on the international stock markets. And you can see it's done worse, right? So it's down 2.76% versus VTI. And so, again, I'm just trying to see, where is the money going? Well, it's not going into international investing, which actually makes sense to me because right now, since the Federal Reserve started talking about raising interest rates towards the end of 2023, we started to see some strength in the dollar. And so when the dollar goes up, you're converting back this foreign currency back to a dollar, back to the dollar, and you could actually do worse than that. So if you buy a stock or an ETF that's international and it's up 5%, but the dollar goes up 10%, you actually lose money in that situation. So that makes sense to me, but I always like to check. And then the next thing I always like to do is, how is the large cap doing versus small cap? So I've just clicked the VOO, which is the Vanguard S&P 500. So this is a pretty good replication of the index that we talk about all the time on our daily videos, which is the S&P 500. You can see it's down 1.5% versus 1.71 for VTI for the total stock market. So that does tell me that some of the money is going towards larger stocks, or at least not leaving there quite as fast. So people are hanging in there on some of their bigger stocks, and I can kind of confirm that by looking at this next index. And so this VXF is every other stock on the stock market that isn't included in the S&P 500 that is in this VTI. So again, it still doesn't include some of these really small microcap type stocks, but it includes most of them. And again, you can see that fell even farther. So right now we're seeing large cap do a little bit better, small cap doing worse, and international's not doing that well. So, we're kind of narrowing it down. Next thing I'd look at is kind of value versus growth. So here is VTV, and this again, Vanguard. I like using Vanguard for these because they have very broad indexes. They have very low internal costs, so I can kind of get a really good sense as exactly what's going on in that particular category. And you can see value is the worst one we've looked at so far. It's down 3.76%. And so that's pretty fascinating to me because theoretically, when in a higher inflationary environment, values should do better. But what's happening right now is because the Federal Reserve, and you can see actually the Federal Reserve met right here and came out and spoke, Chairman Powell, and they talked about raising interest rates. What happened was that took some of the heat off of the thought of inflation. Because if the Federal Reserve does start to raise rates, that generally keeps inflation under control. And I think there was a period of time where the market was concerned about what the Federal Reserve was going to do. So value is a place where money is actually leaving, because that's another thing I look at also is where's the money leaving from. And so, in this short period of time here, we're seeing some motion out of value. And let's see if it's going to the growth side. All right, so again, this is VUG, and this is Vanguard's growth. Hey, it's up. That's pretty spectacular, actually. So you got a market that's down. Everything we've looked at so far has been down. Large cap was down less, but it's still down. This is actually positive, 0.72%. So we're seeing, some motion here into the growth side. So that's where I would start to really focus. I'd go through hundreds and hundreds of different growth ETFs and try to see how they're comparing to each other and how they compare to VTI. And so this is the first step that you would be looking at in terms of a downturn and dealing with that. And it tells me that there's some interest there. And so I'd have to figure out what I want to get rid of because I'm usually fully invested. I believe in being in the market, except in extreme situations. So what am I going to get rid of, to buy these? That's sort of another story. But essentially what's happening here is I'm seeing that growth is doing quite well. And I'll give you a couple examples. We just purchased these over the last couple of days using this process. One is basically an innovative technology ETF through SPDR Spider. and that is XITK. And again, we just bought this, and we've had this for quite some time, but we added it back into our model again, and that is up 1.4%. So even better than the overall growth. There is a motion towards innovative technology companies again. You can actually see that it was kind of falling off, and then at the same time we saw value fall, we saw this run up, and that's because the Federal Reserve met and had their meeting with the reporters right at this time. And when they started talking about raising rates again, and that meant that inflation could be under control, which meant that growth stocks could do better, and a lot of money started flooding back into things like innovative technology. Um, and then the other one that we bought this yesterday, is a cybersecurity ETF, Global X, and it's called Bug. And so that's up even more, up at 1.6%. And again, you can see the same inflection point when things, started to turn around for growth. That's when this started to go also. Now, of course, cybersecurity has a huge, theme behind it, which is, these ransomwares that are happening. Matter of fact, on that same Wednesday, Putin and Biden were meeting, and one of the subjects was these, hacking events and ransomware and those types of things. So this is really pushing, money towards cybersecurity type companies. I have about four of these cybersecurity ETFs that I follow on a regular basis, and all four of them are doing better than the market right now, as well as even in the last month. So um, that's what I would say, that you need to do right now, or that I'm doing right now, or what have you, is just being able to kind of look at where the money's going, what is still doing well. I think you get better information out of a downturn than you do out of an upturn, in my opinion, in my experience, actually. So I think it's a really interesting time to be looking at investments.
So, do you think there's ever a time there this could be just a fake out? People doing super reactionary and like it's going to stabilize next week. Like, how do you know it's a trend versus you jumping the gun?
You don't, obviously. And so, uh, you know, one of the things that I always try to do is try not to fall in love with the thing. So we just bought these two pieces, and I hope they do well. And I've done a lot of research, and there seems to be, some momentum behind them. There seems to be, they're going up when the market's going down. Those are really important things to me. But you're exactly right. I mean, that could turn around next week and turn into something else. And so one of the other things that we have done and we continue to do is we continue to build up our broad market exposure. And so buying the S&P 500, for example, just on the, one of the things, if you're not sure where everything's going to go, buy the whole market. Because over a longer period of time, the market goes up. And so you don't have to know, like, hey, it's going to be cybersecurity, or hey, it's going to be growth versus value when you buy the whole market. So we are right now, because we're seeing so much rotation between growth and value that's happening, on such a rapid basis, which is actually a normal market. That's what's been happening for years prior to the pandemic. Then you want to have more broad market exposure. So you kind of own everything. So if it runs to cybersecurity, well, you own that. If it runs to growth, you own that. And so that's one of the other pieces that we're doing right now, is we're building out and continuing to build out our broad market indexes, like VTI, for example, here too. But because I think it's not a bad time to be accumulating those things when they do come down, because one, the reason the market's coming down predominantly is because they're talking about raising interest rates. But the reason they're talking about raising interest rates is because the economy is doing well. And so a lot of times when I see them start to talk about raising interest rates, the market goes down, and then it finally realizes that, hey, these companies are making a lot of money, and especially as earnings are going to come out here, over the next 3 weeks or so. And so we'll start to see probably some really good earnings, and the market will turn around. So owning that broad market right now, I think, is a really good way to go. And historically, prior to the pandemic, we've had most of our money in broad market indexes. and the minority of the money in things like this, like the innovative technology and the cybersecurity, and that's worked out really, really well. But the pandemic changed things pretty dramatically because an entire section of the economy just closed down, and the broad market really, really underperformed in that environment, and we had to get a lot more targeted. But I think what's happening right now is we're starting to get more back to where we were in 2019.
Cool. So one of these questions came in that's related. Inflation is expected. Is it a good time to invest in the market if I have cash lying on the sidelines?
Yeah, that's a really good question because one of the things that's changed is if you look at what's happening right now, inflation is not as expected as it was. And I know that sounds crazy because everybody is talking about inflation. But if you look at the 10-year treasury from the bond market right now, let's see if I can pull up that chart really quickly. If you look at the 10-year treasury, you basically have this situation where the market as a whole is starting to not think inflation is going to be as strong. Here's the Yahoo Finance, and this is the 10-year yield on the 10-year treasury. And you can see, we had this big run up, and that was the expectation for inflation. But now what's happened, we kind of have been falling. That's a lower peak, lower peak, lower peak, lower peak, and we're hitting lower lows also. So the trend is down. So what the bond market is telling us right now is that inflation is mitigating itself. And what happens then is that you'll start to see some of the areas of investment. I think it's a great opportunity to buy in that environment. So I guess my first thing would be to challenge the fact that inflation is expected. Yes, within the general population and what have you, but the bond market is a much better predictor than the general public, right? And so the bond market is lowering rates. It lowers rates because it feels that the inflationary pressure is going to be less. And the reason that it feels it's going to be less is because now the Federal Reserve is talking about taking action at some point in the future to start to tighten things up, which will maybe keep inflation at bay. I do think it's a challenging time to invest because we're not sure what's going to happen. We haven't had a pandemic for 100 years. And so, what do we do here? And then again, that is why we are broadening the portfolio into more of the broad market and a little bit more away from the growth versus value components that we've had, in the recent past. So I do think it's a good point. I think there's some good opportunities to buy here. You might want to kind of dollar cost average as things come through here, but I do. I think that inflation expectations might sort of start to mitigate here, and that could be even better for the market.
So you're saying like a good, healthy economy has some inflation. It's
Yeah.
only when inflation goes wildly out of control that is drives the market, kind of makes their fear in the market.
Yeah, I've said this forever with my clients, which is just, the stock market reacts so negatively to increases in interest rates. And really, the only reason they're raising interest rates on the Federal Reserve level is because of the expectation or the reality of an economy that's doing well. And that's exactly what you want. You want an economy to do well. But yeah, there is that Goldilocks piece, right? If the economy does too well and you get that higher inflationary scenario, and then the Fed has to chase that down very aggressively, that causes problems because now all of a sudden you start to see this, reversing because, whoa, inflation is out of control. And so and the reason we've seen, this movement, from August through here is the fear that inflation could get out of control in this reopening, especially because the government keeps pushing out so much money, right? Between these stimulus pieces and what have you. So, yeah, you need some inflation. As a matter of fact, over the last 12 years, inflation's been too low. It's been below the Fed target. And for the first time this summer, the Fed has changed what they're trying to do. They were trying to, get 2%, but what they would do is every time it got near 2%, they would start to increase rates, and they weren't averaging 2%. I think it was a 1.5 to 1.75% on core inflation. And so now they're talking about letting it run to 3 to try to get an average of 2. That's a big difference, and it could be very healthy for both the economy and the stock market. I'm super excited about that. We'll see how that works out, but that I think is a really big difference, because most of the big crashes, 2000, 2008, and even end of 2019, were periods where the Fed was really, in hindsight, they were over raising rates. They were getting too aggressive. And when they did that, it brought that down. And what they talked about this summer is that they kind of realized that. It's like, oops, we have caused some massive global downturns by being too aggressive on raising rates. And now, we need to cut back on that. And so that's what what they're talking about now, which again, I think could be a really, really good thing for the stock market. We'll see how that plays out. But
So here's another question about the Congress. Congress is considering changing the required minimum distribution age to 75. So what's your thoughts on that?
yeah, that's really fascinating because let me give a little bit of history and just explanation. So, required minimum distributions are something that you must take out of your retirement plans at a certain age. So, if you have a 401k or an IRA, those types of things, 403b, 457, you get to a certain age, you have to start taking money out. There's a basically a schedule, and you'll take money out really for the rest of your life if you're following, the minimums, and you must take that out. And of course, when you take it out, it's taxable. So a long time ago, for a very long period of time, the age that you had to start was 70 and a half. And they recently, a couple of years ago now, changed that to 72, which seems awesome because it does give those people who don't need it a little bit more flexibility, an extra year and a half where they don't have to take it out and don't have to pay taxes on it. And it can grow tax deferred that way, which again is a big piece of the puzzle. Now they're talking about the possibility of raising it to 75, which again is a really good thing. I read a stat somewhere that it was roughly 70% of people take out more than the minimum. So it doesn't really matter to them. They need the money. They're living off of it. They're taking out more than the minimum. But for those people who don't need the minimum, who really have other income sources and don't want the taxable income, stretching it from 72, where it is now, out to 75 is a good thing. Now, what's being proposed is it wouldn't be immediate. It'll phase in. I think it was 2035, or I can't remember the exact years, 2032 maybe, where, at that point, 75-year-olds would be, starting to take out money. So, but there's a big caveat to this, because when they increased the age from 70 and a half to 72, they also took away something. See, they're trying to oftentimes find something else to generate revenue. So, hey, we gave you something over here and you're going to save some taxes, but we still need money. We still got to pay our bills. So we're going to increase this tax over here. And what they did was that they said, all right, beneficiaries of IRAs won't be able to take it out over their lifetime anymore like they used to be able to. They now have to take it out over 10 years. That's dramatic. And again, it depends on your situation whether that matters, but I got a lot of clients where that matters, and it's a huge problem. I would rather go back to where we were at 70 and a half and still have the beneficiaries be able to take it out over their lifetime. And I think if you surveyed any of my clients who cared about their beneficiaries, they'd say the same thing. And so this proposal to go to 75 hasn't been defined yet and is not done yet. And so we don't know what's going to happen. But my fear is they're going to find some other thing that could be worse that they're kind of, increasing a tax on in order to, offset the 72 to 75. So again, it depends. If you don't have, beneficiaries that are really important to you, then 75 is great. It's because it's you. If you do have beneficiaries, then the move from 70 and a half to 72 is kind of a disaster. So, again, we'll see what they do. There isn't anything that I've read about or seen talking about what increases they might do to offset that, that situation. There's even some talk of getting rid of the RMD, which I would be totally in favor of, because it's a nightmare. I have a lot of clients with $1 million to $5 million in retirement plans, and they're looking at a tax time bomb, right? I mean, just unbelievable taxable income that's going to come out, in their 80s and 90s. And again, the reason they have these accounts is because pensions are gone, and companies replace pensions with a match on a 401k. And so that created this huge amount of money, and now they still have these old rules for IRAs and what have you of withdrawal called the RMD. I predicted over 10 years ago that they would have to adjust the required minimum distribution rules because the amount of money coming into these retirement plans was going to explode, and there would be a lot of political pressure from people that have these really big accounts that are, you're 90 years old and you have a $600,000 taxable distribution. It's a good problem to have, but it's a nightmare, having to pay that taxes. So some flexibility there, I think, would be a good thing. So, it's an interesting question.
Do you think it's just with like demographics shifting, people living longer? This is just kind of, a change for the demographic rather than actually going to take away something in a sense?
It is, and that's part of it. But I think it's political pressure. Again, they got people taking out hundreds of thousands of dollars out of their retirement plans and paying taxes, probably complaining to politicians about that. But that's exactly right. I mean, they, you know, used to get Social Security at 65. Now, younger people is 67. That's probably going to move. Maybe it'll be 69. And again, that's because life expectancies are getting longer. So if you had to start RMDs at 70 and a half, and then it's 72, 75. So yeah, there is an aspect of that makes sense, just in the sense of being able to start later because you're going to live longer. But I think the bigger issue is really just that tax time bomb, and there are more and more and more people that are facing that tax time bomb.
Yeah. So another question that's kind of pre-retirement is, how do I balance short-term and long-term goals, such as a down payment for a house, my first house, versus saving for retirement? Um, that's pretty good question because when you save money now, it's so much more effective later on because you have so much more time to compound it. And so saving for a down payment is you're giving up something. It's a trade-off. And so if you're living in the Bay Area, for example, in San Jose, the median house price is $1 million.
Wow.
You're putting down 20% for that. That's 200,000.
Yeah.
And then if someone's saving on a medium household income, which is about 120,000, and
Yeah.
you're saving 20% of that, it's going to take you 8 years just to have a down payment for a house. And that's kind of crazy. And so if if you want to live in the Bay Area, you got to change up your plan. You might not be able to save that aggressively without giving up something else.
Yeah. No, that's a really good question. Actually, it's really interesting because think about that. You got 20%. That's a lot. Not many people are doing that, but if you're really motivated to getting a house, and that still takes you 8 years on a pure savings basis to get enough money to buy this home. And then what are you going to do for your retirement plans? How much are you going to put in your 401k? How much are you going to be able to put into an IRA or a Roth or any of those things when you're already saving 20% towards this home? And so I do think if you have a 401k, somehow, some way, you got to, and it has a match, you got to put in enough to try to get the match. So if it's 3%, right, and they're going to match that, that's 100% rate of return. If you put in $100 and they give you $100 more to put in there, and now you have $200 going in, wow, you just can't pass that up. And you're right. I mean, I've seen some amazing studies with people that start savings for retirement, just 10-year periods, like 20 to 30 or 30 to 40 or 40 to 50. And the 20 to 30, that earlier period of saving same dollar amounts, it's unbelievable how much more money they have at age 65 than somebody who even started just 10 years later for 30 to 40. But the Bay Area is a really extreme situation because of house prices. And so if you really want to stay here, and I personally feel like staying here has some significant financial benefits. I have a lot of clients that have done really well. It was hard to stay here. They had to do a lot of things to make it work. Um, but they also created a lot of wealth. And then in retirement, they could then move if they so desired. And, we do have clients in 26 states outside of California because of that. So I do think there's some advantages to trying to do that. But you're right. I would say that, other than the match, you probably have to go for it and put as much as possible towards the home. although I would be looking for any other situation that was available to me that might shortcut that and make it a little bit faster. So, a lot of the times when I see people buying houses, they had a company that they're working at, and they could buy the company stock, and so that was something they were putting part of that 20% towards, and it worked and it went up, and they had some money that way. Or they worked at a company that got stock options, or their parents were able to either give or lend them money. There kind of needs to be something that happens that isn't in the norm, where you're just plunking away a few dollars a month, hoping to catch up to the price of homes. I mean, I'll give you my story. I was very, very interested in trying to buy a home, wanted to have a family. My wife and I are, saving some money. She had some money that she had saved prior. And so we kind of just went for it. I used to get in my car, put my bicycle on the back, and I'd go park. I wanted to live in Willow Glen. My grandparents built a house in Willow Glen in 1936, and I was really interested in living there. And so I would drive up and down this 10 block by 10 block area that I consider Willow Glen, and I ran across a house that was for sale by owner. Actually, the woman was putting the sign in the lawn at the time when I drove by. And so I stopped and talked to her. And this house was a disaster. It had been built in 1924, and that's what I was looking for, was a disaster. So, because I wanted to do something like my grandparents, I wanted to kind of build a home, and I couldn't afford much, so buying a disaster was kind of what was available to me at the time. And the house had actually jumped partially off of its foundation in the '89 earthquake, and they just kept living in there. She takes me through. I'm looking at it. I mean, you put a marble on the floor, it would roll all the way across the room. And so, we were in a bidding war for that home, and we ended up, getting it. And then, we actually, built a new home on that and didn't have to put down anything more, because the new home and the construction of that new home basically was worth more than the existing home. And that equity credit that we kind of built up by building this new home was the rest of our down payment. And my sister got a job offer between HP and Cisco. At the time, Cisco was 250 people, and she wanted me to do some research. And so I did some research, and man, I really like Cisco, so I bought some, and that was a big piece of what we used to buy the house with and such too. So I think if I'm looking at trying to buy a house, I'm going to get more aggressive. I'm going to probably try to find a Cisco if I can. I'm going to save money, left and right. I'm still going to try to get my match if I got a 401k. I'm going to look for special situations. Maybe I'm going to go into a condo and then work my way up, whatever it might be. That, I think it takes something standard. I didn't have parents with money. If I did, I would have gone there. Honestly, I don't have any problems with that. But that wasn't an option for me, so look for every resource, because it's so hard to get in as far as that goes. But it's a challenge, but I think it can be done. It's worth, getting through that challenge could really be an amazing thing for you. My business is bigger than it ever would have been if I wouldn't have bought a house and if I wouldn't have lived in this area. So those types of things that I think have paid off for the long term.
Yeah, there's some crazy stories of people taking big risks on their houses in the Bay Area, and
Yeah.
but there's some safer options. Like you could go out to the East Bay where it's cheaper than San Jose. You might have a longer commute, or you go south to like
Yep.
Gilroy, Watsonville, Morgan Hill, or you take something smaller. Um, I know my friends that are trying to stay in the Bay Area. They've all started with condos. They've
Yep.
foregone the two bedrooms,
Yep.
the houses, because they just can't compete.
Yep.
And it's kind of crazy how the market is right now. Like, for example, like, there's a house that one of my friends wanted to buy. There's 14 offers on it,
Yeah.
and they couldn't compete.
Yeah.
It's so. Do you ever think it's like take the risk of withdrawing from a retirement account to get into like having that down payment to compete with these bigger offers?
Yeah, I'm not completely object to that. I do think, in this particular area, the real estate market's pretty unique. Part of your retirement could be your home. The clients that live in these 26 states outside of California have cashed out the money that they made in their home. And so that could be somewhat of a retirement scenario. The problem with doing a straight withdrawal is just, when you're under 59 and a half, you can get penalties. There are some capabilities. I don't know what those are anymore. I used to, but where you could take some withdrawals for housing without that penalty, but you're going to lose this asset. I did take money out of my IRA and then put it back within 60 days, which is free. There's no penalty, there's no tax. You do have that capability of pulling money out for a 60-day period. I did that, in the construction of my home, actually, in that process. So um, yeah, I don't have a real problem with some of those aggressive things. It'd be really interesting to see how it plays out on a spreadsheet and take a look at it, in a financial plan. But you're right, the condo and the out of area. My stepbrother bought a condo down in Morgan Hill. They've made a bunch of money on it, slowly but surely. They've been fixing it up themselves, and they're looking to try to move up and buy a different place, at some point here also. So yeah, you just have to consider every option, and there's a lot of them, and it's very competitive. And at some point in time, you have to be able to say, am I really capable of competing in this market right now? And if the answer is no, then just wait. Eventually things tend to cycle around, and you might have a better opportunity at some other time. Matter of fact, in the case of my stepbrother, he bought that, at a time when things were down, and they actually had an assistance program in Morgan Hill, where he was able to qualify for a really low interest rate loan and what have you too. So, there's different things that happens when things do slow down. So, otherwise, figure out how to get more competitive. You're basically in the major leagues. You're in one of the best housing markets, that I can think of. And, you're trying to compete. And so how do you compete? How do you get more competitive? You get more money. You do some more things with your investments. Like you say, maybe you move down to a different area where you can compete. And deal with the commute for a while, with the idea being that, hey, I'm going to eventually not have this commute because I'm going to build up this equity in this condo in Morgan Hill or wherever, and I'm going to then use that equity to move up, and I'm just going to keep going. And that's a very standard practice. I've seen a lot of clients do very well with that over the years.
Yeah, I looked it up. You can take out $10,000 per person or your IRA,
Oh,
penalty free, for your first house.
awesome. Okay, good.
And then I think for 401k or loans, you can take half of the value,
Wow.
or whichever is small or bigger, or $50,000, or whichever is smaller, fifty
Whichever's
thousand
smaller, yeah.
dollars. Yeah.
Yeah, so there you go. I think you have to kind of tap all your resources. I wouldn't have a problem doing a loan like that. Again, this is my house. You're looking at this is my living room, so and it's been awesome to have. I've made a lot of money on the home, over the years I've had it. I've had lots of headaches with the maintenance and things there. It's not, the dream is sometimes, reality isn't quite the same. I've had a flood from a burst pipe, so stuff happens, but yeah, I think it's worthwhile. It's really an amazing goal to reach, to be able to kind of get that property. And so, just keep working at it and look at every single avenue that you possibly can. And that's kind of how it works.
Yeah, it's crazy trying to get a house in this area.
Yeah. Yeah.
Um,
Especially right now. Interest rates are fairly low on the mortgages, and they're starting to pop back up right now. And every time that happens, a bunch of people jump off the sideline. They kind of panic, right? So if it goes from 3.25 mortgage to 3.5, oh my gosh, it's going to go to 4. And so we better do something more aggressive and make a more aggressive offer, right? And so usually when you see rates start to inch up a little bit, you see even more offers coming in, and it gets more competitive as far as that goes. But yeah, it's I still wouldn't shy away from it. Look at it as a challenge, and look at it as something that you really want to accomplish. I don't have a problem with people that move out of the area that don't feel like that they want to deal with that, or don't feel like they can compete. That's fine. But there are a bunch of people that move out of the area that probably could compete. And again, you got to be careful where you go. You may or may not make that much money on your home too. So, uh, if you can figure out a way to compete in this market and get what you want, you could create some really good wealth. I've watched it over the decades, and this is a pretty amazing place. There's just not that much land. I have cousins up in Davis and Sacramento, and they've made some money, but nothing like we have, just because there's so much flat land. I have in-laws in Kansas City, not Kansas City, in Wichita, Kansas, and they had a house for 20 years that they actually didn't make any money on. So, again, because there's so much flat land. So this valley is pretty unique. It's worth the effort, in my opinion, if you can do it.
Yeah. So do you believe it's you should take like bigger risks? Should I be more aggressive with my like usually for down payments, a lot of people say save it in something that won't lose it, like a bond fund or something like that that's super safe. So to compete, do you think we should be putting that money into the market and being risky with it?
I would. I did actually, because I don't think you can keep up unless you have a really high income and a really good savings rate. Then that would make more sense to be more conservative. But what you're trying to do, you're trying to catch up. I mean, house prices are going up a lot faster than that bond fund or that CD or that bank thing. Now, I might keep some money in those, that's for sure, and I did. But the reason I got a house is because I bought a house that was falling apart that I got for cheap, and I was willing to build a home. That was a lot of work, but I really enjoyed it. And I bought Cisco when it was 250 people. And I put in my effort, I put in my due diligence. I probably wouldn't do something too crazy. I honestly probably wouldn't do cryptocurrency, but it's just not my personality. I know people are making money at, those type of things. I don't know if I'd go that far out, because I'd probably go with something solid. I mean, Cisco was sitting on, right on the front of the internet age, and they were making the routers that the internet was essentially going to run through. And they were growing like wildfire. They had my sister in a little closet, and then they built these big buildings, and they were they were really going. So there's lots of things out there like that I would take a look at, even if it's just a fairly aggressive set of ETFs. But I probably would, because what happens then is if it doesn't work out, generally speaking, if you hold on, it might come back. You got to be a little careful when you're dealing with individual companies, because they can go out of business. But I probably get a bit more aggressive, and if it doesn't work out, it just takes a little bit longer than it might have. So theoretically, you still have a place to live wherever that is that you're living at the moment. But yeah, I would probably put that as part of that competitive package, is at least some portion, 20 to 50% of the money that I was trying to save, going into something more aggressive, because that's what gives you that bump to get there. Now, again, it depends. I didn't have other resources. Honestly, if my parents could have lent me the money, I wouldn't have done some of those things. I wouldn't have. I just would have convinced them that I was reliable, could pay them back. And so an awful lot of people that I've met have had help from parents, and nothing wrong with that either. And man, I'm really looking forward to trying to help my kids out, for example. Um, and so that, again, it depends on the situation as to what you should do and how aggressive you have to get. You have to take a look at every scenario, but it's a mindset. It's a single mindset. I had a picture. I found a house that I liked in Willow Glen. I took a picture of it. I put it next to my mirror. I looked at that picture every single day when I was getting ready, and I thought about that, and that was my main goal. My burning desire was to get that house. And I ended up with a house that looks almost exactly the same. We actually hired the same architect. And I love it. It's just a beautiful home, and I'm really happy with that. So, and that catalyzed my whole practice. It catalyzed my whole life. It's catalyzed this, probably about $2 million of growth that we've gotten, in that place. So again, it takes that kind of focus and that kind of attention. And I do think that's what you get out of this, besides just a house, is a pattern on how to get somewhere, because your next focus could be getting your kids to college, or getting, your retirement set up, or whatever it is. You just go for it. It depends. I probably wouldn't be aggressive if I had parents that could give me the money. I'd be saving in a much more conservative manner. But if I didn't have that, how are you going to get the money? House prices are growing at a faster rate than anything you can save. And that was my point to my wife. She had been saving money for college, and she, wasn't keeping up with the value of home growth here. And I was like, hey, we got to do something with that in order to get there. And it was a tough conversation because she's a lot more conservative than I am. But it worked, and she's happy with it. We both are. Yeah. And, we raised two kids that are now kind of off on their own, going to college and what have you. But it's a good place.
Yeah, looks like we're just at time. So
Great.
just to remind everyone, you can always send in questions to asktom at golive.com or golive.com, golivewithtom.com.
Yeah, and again, please subscribe if you really want to continue to. We're going to take these Go Live with Toms. We're going to divide them up. So if you just want to watch one piece, that's a great place to go. It's right on our channel. We're working on these what I call subject videos. So right now, Ethan and I are working on one about cybersecurity ETFs, what's out there, what we would choose, those types of things. And we'll continue to do those types of areas. And then there's a daily video that goes on there, obviously, every day, where I try to talk about what's happening and, where you might want to go and, how you might want to react to that. And so, all of that's available on our channel. I think we have a really good resource there. So just push the subscribe button and the little bell if you want to get notified of that, and we can take care of you. So I want to thank everybody very much for coming. I really appreciate it. And we'll see you next Friday. Thank you.